Hello everyone. Welcome to TO Markets Tools of the Trade webinar. This is a live trading strategy workshop, so your questions are more than welcome and I'm more than happy to help you with those questions. I tried to be quick with this material and basically go through some basics first so that you catch the the fundamentals, why this is something valuable, why this could be useful for your trading strategy. And this is, I could go straight into the signals and material, but I want to give you a good understanding on why things work, way they work, and hopefully this is something useful for you and will help you in your trading development, in your development as a trader. And if you have any questions throughout the webinar, please let me know. I will help you out. If I know the answers, I'm more than happy to help you out. So, I just wanted to mention this. This is what we're looking for: good reversal signals, and we have an excellent trading environment for these kind of trades. So, you don't pay any monthly subscriptions fees. You don't pay any per trade commissions. You don't pay wide spreads. Plus you get instant execution, you get TO Shield, etc. You get lots of benefits, and I would highly recommend you to either email or phone us, let us know that you're interested, and our salespeople, support people will be more than happy to help you out with this. So, we have been looking at different kinds of ways to really understand where the market is going. So I've been, in the previous webinar I was talking about moving averages, how we can understand and analyze and recognize momentum using moving averages. You can find that webinar there in the let's say if you don't have this webinar, we'll provide you the link. And if you're watching this later on a video, just email support@tomarkets.com and we will email it to you. Now, in this webinar we're going to take a look at oscillators, trend lines and Bollinger Bands, and I'm also going to talk to you about this trading strategy idea, and then later on I'm going to introduce you to some other tools also. So the purpose of this webinar is to help you to measure momentum, recognize changes in momentum, use momentum to enhance your trading decisions, and identify powerful trade entry setups. This is really what we are aiming to do today. My background briefly: I've been trading futures for a hedge fund, I've been working as a team leader for investment advisors, portfolio manager, excuse me, and as a chief market analyst for excuse me, let's take again. So I have been working as a chief market analyst before for another forex broker, and in this role at TO Markets, again as a chief market analyst, it is my sort of privilege to really help you guys with my analysis and help you with my education. So I love to do this, and the more questions you throw at me and more you interact with me and challenge me, the happier I am, because I really want to hear your questions and I want to be challenged if there's something that doesn't make sense to you. But before we move on, please remember that all the views expressed are our opinions only. We don't provide any investment advice. So if you don't agree with this disclaimer, it's, or let me put it in other words, only view this webinar if you agree with this text and disclaimer here. You can take a screenshot and read it on your own time. Good. Okay. So, quick recap on momentum. The last time we talked about momentum as being the rise over run. This is how it's mathematically defined. So let's say that this is a market moving steadily higher. this is the slope of the of an uptrending market. And as you can see, for every step of 3 units, or every 3 units, we make 2 units on price. So the price moves up by 2 units if there is 3 units of time. So that's how we get this rise over run being 2 over 3. If the market is moving higher, steeper, then obviously we have a higher, more strong momentum, and sometimes the market moves very slowly. It just slowly drags itself higher, and that's obviously then you have less ground covered over a longer period of time. So that's how I'm showing this to you, so that you can understand the momentum indicator later. Cool. Now, upward momentum means that basically we have new inflows into the market, and downward momentum means you have new outflows of the market. So no market can move higher if there is no new money flowing into it. And what does it mean practically? Let's go and see. Just a moment. I'm going to show you a chart here. So now, when the market moves down, you have sellers coming in. There's more and more bulls that are converted into bears, and there's more and more supply coming to the market, and then gradually at some stage there will be, all the buyers have sold what they have, and more people are turned and sort of converted into bulls, and the market starts to rise higher again. And now we have new inflows into this market. So when this is gold here in 1 hour time frame, if gold is rising higher, more money is coming out from stocks. For instance, equities might be going down, some other markets might be going down, but gold is moving up. And the same is repeated here. When we have a point where people don't believe into prices going higher anymore, we obviously get more sellers in, and the momentum changes. So we're trying to identify in this, with this material that I have here, I hope that you will be able to identify momentum changes, how the market moves, how it is likely to move in certain situations. Obviously we don't know the future ever, but we can understand some things that make it probable that for the market to move into certain direction. We think here, because the market starts to create lower highs, we think that it's probable that it's going lower. We don't know it, but always with markets, you just have to forget the idea of knowing something. People spend a lot of time and a lot of effort trying to create something. In terms of trading strategies, they try to create something so perfect that they can know that the market moves in the direction of the signal, and that's never going to happen. There'll be problems. There'll be false signals with every single strategy, and if your signal says somewhere here that you should be selling and you try to sell, obviously that's going to make the life very hard for you. I always talk about markets as the Mrs. Market. It's all of us who have been in love with markets and trading for a longer period of time, we know that Mrs. Market is kind of bossy person. If you want a good marriage with Mrs. Market, you have to obey. You just have to, you have to be able to say, okay, I really don't have a will of my own. I'm always ready to say yes, dear. So if the market says up, then you say yes dear and follow the market higher. If the market says down, then you just say again yes dear and you follow the market down. So there's no point, whatever your system is, whether it's based on fundamentals or technicals, there's no point in trying to fight the market because you have an idea. You have to always follow the price action and try to understand what is the idea that the market has in the moment, and then just follow along. So oscillators, there are two types of oscillators mainly. There's momentum and MACD that are kind of centered oscillators. They have center lines that they fluctuate on both sides around this line, and then you have RSI and stochastics, which are capped in the sense that they can't move below a certain limit or above a certain limit. And what I'm going to use here is momentum oscillator, which is also known as ROC, rate of change. Okay, here I have both momentum and ROC in the same picture, so that you can understand they are pretty much the same. I really don't understand why most charting packages have both of them, because they are just the same indicator. And you can see that they oscillate around the 0 line. They can move to, like RSI can't move beyond 100 or below -100. This indicator can move to any number really. There's no limits there. So you can't, that basically means you can't look for sort of overbought, oversold levels with a momentum indicator. It's what the name says it is. It tells you what the momentum is like. Now, with all the indicators, for the new traders, I want to mention this, all the indicators have something called a look back period. So it's basically a period that this, if you look at the bottom of the screen, there is the formula for this indicator. So you take a close and you subtract a close X periods ago. So that's what you need the look back period for. So at this point, if you have a look back period of 12, at this point the indicator is plotted based on the difference between this candle and the candle 12 bars ago or 12 candles ago. So that's the way the indicator works mathematically. You can try to sort of, if you look at these peaks and lows here, peaks and troughs, you can see how they roughly coincide with the highs and lows in the indicator. So you might want to use those. Obviously, when the indicator comes down to this point, we don't know if the market is going to go lower. If the indicator is going to go lower, you need one candle that closes to the opposite direction in order for a sort of trough to create. And the same here. So the signal comes always here if you're looking to use the indicator in that sense. But I have something different in mind in my sort of schedule for you today. Agenda, I think is the word. So what we are talking about, we have y-axis, there we have the price, and on x-axis we have time, and this is just a reminder for you what the indicator is trying to sort of establish, how it helps us. Okay, I promised in the email that I would talk about Bollinger Bands indicator also. I'm not going to use this in the sort of trade entry signal setup that I'm going to provide you, but I'm going to throw this in because I promised. I want to give you an idea how you can use Bollinger Bands indicator to recognize where the momentum might be. how the momentum is developing at the moment. So just briefly, Bollinger Bands, without going too deeply into the maths of the indicator, it's really based on price distribution around an SMA. So there's an upper band that is 2 standard deviations above the moving average, and there's a lower band which is 2 standard deviations below the same SMA. And here's an example. Here's the upper band, the moving average, and the lower band, and as you can see, when the market is trending lower, and this is Nasdaq E-mini futures in 1 hour time frame, obviously you can use all of these indicators in any time frame, whether it's 1 month or 1 hour, it really doesn't matter. But if you want more signals, you obviously choose a time frame that is intraday or shorter than a weekly time frame. So when you see the market moving down, it is typical that the price moves between the lower band and the moving average. So that's your indication of market moving down. And the opposite happens here. When you have the market being bullish, it moves mainly between the moving average and the upper band. Obviously, every market will have periods when it doesn't move ideally. It kind of chops between the upper band and the lower band. I said ideally referring to trending kind of periods. If you are somebody who wants to trade ranges, then obviously when the market is moving in a range, then you would prefer something like this, market bouncing between the levels. But I chose this as an example that you have kind of false moves in terms of trends. The market participants think here that the market is ready to move higher and they start buying, but then lower highs start to develop and the supports are broken, and the sort of market has to go to a deeper level to look for buyers. But I find this, when doing sort of trend analysis, I find this quite useful, that if you have Bollinger Bands in place and you can see the market constantly moving between these 2 bands, so the SMA and the upper band, then you know that you have an uptrend there. Okay. The next trend lines, I know this is very, very basic, but I just want to quickly share this with you. You have 2 points, you connect those points, and you have a third point where you look to buy if the price action confirms the buy, and the same on the downside. You connect the points and you have a third point or an area where you think you might want to sell. And I just want to cover this for new traders. We can go into trendline analysis later on a little more, just basically because we have many different ways of drawing trend lines, and there are challenges that there are challenges because the markets are a little bit more choppier than this ideal image here. But we can talk about that later. I just want to cover this material first. So now we're getting to the really something that brings all of this together, because the reason I wanted to show you all of these is that it's difficult to find edge in trading if you only have one approach. If you have a moving average, or if you have trend lines, or if you have a momentum indicator. So if you only choose one of those tools, it's difficult to have an edge. But when you combine those, then you have a lot more understanding on what's happening with the price, and then obviously with that understanding you can make more informed decisions. So this trade entry idea, it exploits momentum changes by identifying buy and sell areas, and here we use momentum indicator fluctuations and trend line breaks. As you saw earlier, the momentum indicator moves up and down with the market and fluctuates around the zero line. So we need those fluctuations, and I'm going to define this more in more detail in a moment. But we also need trend line breaks, and I'll give you a few examples on how to sort of have early warnings and then confirmations. But first, before we go there, obviously we need those tools here, but I wanted to show you this disclaimer. This is an entry strategy idea. It is not a complete strategy. Obviously, if you want to create a complete strategy, you need the entry rules, you need exit rules at your profit targets, at your stop levels, you need money management rules, how much money you risk per trade, how much money you risk per day, how much money you risk per week. All of these things have to come into consideration. Do you scale into positions, or do you just take one single shot at the market per signal? All of these considerations have to be taken into account. And that's why I'm saying this is an idea. Further research, further development is necessary. So I would say, once you've seen this, and if you think it is useful for you, if you find it interesting, go and try applying it with historical prices. See how the market moves, and after you do that, you have better understanding what are the strengths and what are the weaknesses of this kind of approach. And most importantly, this is highly important, no strategy is perfect. No strategy is perfect. False signals will occur. There's no way around it. So you see lots of marketing where people sell their surveys or systems or indicator models, whatever, and they say that they have 100% success rate or 90%, 80% success rate. But I tell you, if you can find something that is, say, 60%, 65% successful. So if you take 100 trades, 60 to 65 trades are winners, and if after those 100 trades you have more money than when you started, then you have a pretty good system there. So because of these false signals, strict risk management is needed. So with these in mind, we can move forward. Excellent, we got some more people into the webinar. Welcome Isaac, welcome Pacific. Excellent to have you here. Really lovely that you were able to join us. Now let's go to charts here. I'm going to bring up a gold chart in just a moment, and this is going to help us to understand what we are looking to do. So here's the chart, and basically I'm using, for presentation purposes, I'm using this trading view, but for trade execution I definitely prefer, let me just try to zoom this in a little bit. So trade execution is so easy with MT4 and MT5. TO Markets provides you with MT4 or MT5 platform, so use those for trade execution, and this is only for presentation purposes, as there are some features that help me in presenting the material to you. Okay, so when the price moves like this, there is, if we would look back from here to the left hand side, there is prices there. You have prices moving lower, we have a downtrend, but now we are really focusing on the latest developments here. And let's take this a little higher so that you can see the momentum indicator. The indicator here is it's a 6 period momentum indicator, and as we discussed before, ROC is exactly the same if you want to use that or you happen to use that. So momentum 6 periods as a look back period, and here we have something interesting. Here we have the momentum indicator making a higher low, higher than this trough here. This is lower than this, so here we have an early warning that the market might be turning higher. Then a little later we have another one here. This obviously, this trough isn't ready before this candle here, so you need an up candle to create a sort of negative peak or a trough here, and then obviously you need a green candle to have another higher low. But what's significant here is that we need two different factors to have a signal. So these are your early signs, the momentum fluctuations in the indicator. But then the other factor is a trend line break. And as you can see, we can see from this price data here that there is no trend line break yet. The price is still below these. Let's use that line tool here. The market is below that trend line. Sorry, not that trend line because that's in the future, but here we have another one. Here we have another one. And here we come to the question, how do you draw trend lines? Because there's obviously lots of different ways of doing that. Some people prefer to use the candle bodies, some people prefer to use the points where you have most touches, some people want to use the spikes. But I'm thinking if you have lots of points touching the trend lines and they are always just estimations, rough estimations of trend, then I mean that's good enough. So looking at this point here, let's focus on it again. We have higher lows in the indicator and we need the trend line break. So the trend line break comes here actually. We have price moving above the downward pointing trend line, and that is the long entry, the buy signal as per this approach. And then the price starts to move higher. So two phases. First you start get indications of price possibly turning higher, and then confirmation price breaks the trend line. Okay, but I want to be very open with you. I want to be very honest with you. And as I said this already earlier, there are false signals with every strategy. You can see videos in the internet where people say, okay, this awesome setup is so great that we just get all these nice signals and we don't experience any losses. But the truth is, yes, we do experience losses. That's why we need risk management. I mean, there are traders, the best traders in the world sorry, the best traders in the world, they make over 300% per year. And when you ask why they were successful, they say that risk management is the key to their success. So if that's what the best of the best are saying, then why should it be any different to us? We need risk management, and I'll show you why. This is just the reality of the market. You don't get markets that are always moving in your favor and following your signals. That's just it's unrealistic, to put it nicely. So here we have market that breaks a support and drops lower, and then we have a higher low here in the momentum indicator. So what do you think? Is that a great indication of price probably moving higher now? I mean, be real. No indicator is valuable in every situation and explains all the market movements. This is just a simple comparison of two price points and how fast the price has moved between the points. So when the market has just topped and broken support, then indicates a signal here isn't of great value. And just briefly, I'm going to give you a quick bonus here. Let's use this arrow. The markets move in stages. The first stage is, and let me make this a solid line. The first stage is accumulation stage, when the market usually chops around and moves sideways. Then you have a markup phase. That's when the prices are trending higher. That's when the market creates higher lows and higher highs and moves higher. Then you have a distribution phase, the big institutions that bought the assets down here, and then the small traders took the price higher and the big traders start to look for exit opportunities. So that's the distribution phase. And then the completion is the markdown. Here we go, the markdown, when the market is trending lower, and obviously the cycle will continue. There'll be a new phase 1, a new phase 2, etc., etc. So if the market has just moved out of this phase, broken supports like here, and you get signals in the in the momentum indicator, it doesn't make sense to believe that yes, this one spike here is going to be meaningful, or this one here. You need to give the market time to move lower and then start to look for buying opportunities. So let's see. At this point, we definitely have a higher low in the indicator than we have here, and the market has been moving lower for some time. So we have, as per this approach, we have a sort of early indication of market possibly moving higher, and it's complete here on this candle. So actually it's complete here on this candle. Now this is interesting. Sometimes you get a down candle, but the indicator is already up. That's because it's comparing this. It's the momentum indicator. It's comparing this to previous momentum here. How fast the price changed before. But we need the trend line break. So let's go and draw the trend line here. We have two whether you use that one or this one, it really doesn't make any difference. There's a small difference, but let's use that one. Okay. So now we get the trend line break. Oops, we don't need that many lines here really. Let's take those arrows off also. There you go now. So here's the trend line break. Definite close above the trend line. That's the buy signal. Now I'm saying this is a false signal because if you are building your strategy to benefit from big moves like this, then obviously you would hold this and see it stopped out. If you are short-term trader and you just want to take from this is gold prices, obviously you might have seen it there, so if you want to take gold from 1783 or so to 1787, and that's fine, obviously. Or to be honest with you, we never know where the top is, but when we see the price starting to roll over, then we might make a little money here. But I'm thinking this as a signal that, or strategy that is built to catch longer moves. So in that sense, I'm treating this as a false signal, and you can either, to limit your losses, you can either have a tight stop or bring the stop to break even after the price has rallied, and then your risk is limited. The downside risk for your strategy is that you might get stopped out from some trades that then start to move higher. The market rallies, you bring your stop to break even, then the market retraces back to your break even and then rallies higher. So that's obviously the risk. So you need to find the right balance there. Okay, so we have an example of successful long signal here that led to a decent rally from 1783 to about 1810 to 1815. Okay, what about short signals? I showed you that $100 gold short signal earlier. Let's see how it developed. And basically we can stay with the same chart. The price is rallying higher, and as you can see here in the momentum oscillator, we have a slight upward sort of drift here. We have a higher low, then we have a higher high compared to this one, we have a higher low, and we have a higher high. But then something else happens. We get a lower high. Oh, hello Abba. Welcome to the webinar. Great to have you here. We have a lower high here. I'm gonna use the arrow sign here. So that's the lower high, but we don't have any trend line break. And if you look at the chart at this point, it's kind of difficult to believe that the prices are gonna go lower, but if we believe the strategy and the approach, then we want to have the confirmation. Take a reactionary low here, reactionary low there, and here we have a third one, and there we have our trend line break, early warning, and the signal. So that's the signal here. Let's make it red. And then obviously if you enter into a short trade, you want to follow the price action from this point on to see how it develops. And now we can see that we have another lower high, which is good for your short. We have a support broken, etc. and the market, okay, rallies a bit and then eventually sells off. So here we have a successful short signal, and it is, as you can see, it's not based on one single idea or one single indicator. It's based on understanding what is happening with price action, what is happening with the trend. These are the early signs that the trend is growing a little weak. This is the confirmation that the trend is broken, and then the market starts to move lower, and eventually the price moves all the way down to 1708, roughly to 1708, and then rallies. We don't know why the traders thought this level exactly is great. Maybe that it's just approaching those levels I pointed out in my analysis on, if you go to tiomarkets.com/analysis, you can find my daily analysis there. If you go to our YouTube channel, you can find my weekly videos there. And here I pointed out several times, both in video and in the daily analysis, that there was a level not far down from this 1708 low that where there is some very sort of significant support in the market. But okay, so here we are. Here we have the system idea, or the entry ideas. Now, as I said, I basically want to make sure that everybody gets this, because we have new people coming in. This is an entry strategy idea. You need other factors, you need other components for your strategy. You need risk management. You need to be able to manage your positions while the trade is on. You need to have stops and targets. So further R&D is necessary, further research, further development is necessary to develop this into a strategy that fits your idea, your kind of personality and your ideas about what you want to achieve. So go and study the historical prices, and only then start thinking if this is something that you want to integrate into your trading. So I'm not spoon feeding you, if you see what I mean. Okay, there is a question from FK. So based on this strategy, it means gold continues going down. That's an interesting question, because this is an entry technique. It doesn't really sort of take it's a good question though. I like that, thank you. But this is an entry strategy. You obviously get some idea on how to enter the market, but then how to exit your trades, that's a different question. And some people might take this entry here and be quite happy with just a little highly leveraged rally that follows. Some people might want to buy bit by bit by bit and then move as the market moves higher. They might even want to wait for the next signal, but I'm really saying, do your own research there, decide what fits your personality, because some people want to have quick profits, some people want to keep the positions for longer. So this strategy isn't trying to explain the market, all the market ups and downs. And when you see professional traders trading, they often sell uphill and they often buy downhill. That's basically because when you are running a big portfolio, you don't want to impact the market with your buying. So basically, if you have more supply coming into the market, you want to take benefit of that supply and be able to establish your position. So they obviously, that's how they either enter or exit the market. So any other questions? Any sort of, or was the answer helpful? Do you agree with my reasoning here? Do you disagree? Obviously, I want to know if you disagree, and if you have further questions, let me know. You're more than welcome to ask. Okay. If no more questions, then we probably can move on. And let me just remind you of a couple of things. We have a Telegram channel here. I'm going to paste the link into the chat box here. So when we publish new analysis, whether it is videos or written content, we let you know in this Telegram channel. So I think it's well worth doing that. It's free for you guys, so it's just, I would say, yeah, go for it and do that. And then what you could also do is to go to our TIA Markets YouTube channel and subscribe to the channel, just to make sure you get updated each time there is new video content available. So thank you guys, it's been great having you here, and if you have still further questions, please let me know. If you have something else you didn't quite get, and if you need help, any kind of help, then email support@tiamarkets.com, and our very, very helpful support staff is more than happy to help you out. Okay, now that you've been here, maybe you can do me a favor and give me feedback, very simple feedback. On a scale 1 to 5, did you find this useful? 1 if you didn't find it useful, 5 if it was very useful. Okay, can the momentum indicator be summarized briefly, as some of us got in a little late? Actually, to be honest with you, we've been here for quite a long time, so we're gonna email this to you tomorrow, or maybe even today. So you will get the video and you can have the recording. So yes, Abba, yes, you will get the recording. Hey, thank you for your feedback. I'm getting 4s and 5s. Excellent. Thank you for this lovely feedback. This is really encouraging. I'm impressed. And it feels good because I really worked on this. Hey, nice. Thank you guys. So the next webinar is going to be in a month's time. So we'll email you. So just keep an eye on your inbox. And meanwhile, just trade safe, never trade without stops. Please never trade without stops. And if you keep reading my analysis and watching my videos, even the old ones, you start to grasp ideas, what's useful, what's meaningful, what can you use to find trading setups, and then you can start studying those and maybe applying them in your own trading if you agree with my analysis. Excellent. Thank you once again, and see you soon.